Hey, Dalia, thanks a lot for coming on today.
Thank you,
Rob
Rob.
here with Calvert Home Mortgage, hanging out with Dalia Barsoum of Streetwise Mortgages. Dalia, why don't you tell everyone a little bit about yourself and your awesome team that you have?
Yes, thank you, Rob. Well, we are a boutique mortgage brokerage, Rob, that specializes in financing income properties across Ontario, and we also do out-of-province deals for clients who live or hold properties in Ontario. Our forte is really in helping clients scale a portfolio, and we do everything from residential to commercial to private financing, and we're one of Canada's top brokerages in this space.
Awesome. You guys, yeah, we've done some work with you guys. It's great working with you guys. And I know that the services that you provide, especially to those in the real estate investor space, is really valuable because you're helping people acquire properties through different mechanisms of financing, if you will, scaling their portfolios, as you mentioned. And one of the things that I really appreciated about working with you and your team and, hearing you talk and chatting with you is that you're really tuned into what's happening with the market and where there are some pain points for current people and also opportunities within every single market. What are some of the biggest things that yourself and Streetwise are seeing in the market right now in the real estate investor space?
So definitely a shifting environment on several fronts, and it shouldn't be a surprise. Of course, rates have gone up. Some clients who are on what's called an adjustable rate mortgage have seen their payments go up. So that's impacted some cash flow in some cases or budgets. And we have to come up with strategies to help on that front. And then in some markets where we've seen values soften a little bit, depending on which market we're talking about. So that obviously has some impact on equity takeouts or the price that clients were hoping to get by putting their property on the market. Qualification in general has also tightened as a result of rates going up because, as you know, with traditional lenders, they're looking at the higher of the Bank of Canada rate at 5.25 or the interest rate plus the 2%, and now that benchmark is above the 5.25. So that's put some pressure on qualification. So these are things that are happening simultaneously in this new environment we're in, and we're getting approached by clients or by other fellow brokers as well to co-broker files to help address some of these challenges for clients. And my philosophy is always, there is a solution. We just have to look at the big picture, identify where we can tweak things, pivot things, and we've put out a lot of content over the past few weeks to come up with strategies and tools to help clients pivot and adapt to the new environment.
Totally. The saying is, don't wait to buy real estate and wait. And there's challenges in every market. We're coming out of a hot market where it was really tough to get a property under contract because there was less inventory. And now there is more inventory, but because of the rising cost of capital, we're seeing, NOI going down in some buildings. We're seeing tougher property values are softening because we're reducing the purchasing power of people with the increasing rate environment. So it's just a matter of how you manage the opportunity and the challenges. And I love the way that you guys approach your business. And it's always a solution hat and a game plan hat. It's not a fire hose.
Exactly. And to your point, Rob, it's challenges and opportunities. So yes, I've touched on the challenges, but to your point, it's a better market, honestly, for investors to negotiate better, to have time on their side to do diligence. And despite the fact that the rates have gone up, the prices have softened. So there is an offset there, right? So it is a market that allows investors to negotiate and time is on their side versus 6 months ago. Competitive offers above asking, no conditions. It's like craziness. So it's that's the other side of the coin.
Yeah, you know, I mean, if while the cost of money is more expensive, right now you're getting a better value on the asset because the asset price is going to factor in your demand side purchasing power. So the market capitalizes the increased cost of capital at the same
Yes,
time.
yes.
But you reached out to me, you know, call it a week and a half ago, I want to say. You do a lot of work in the private space. I'm an underwriter in the private space. You outlined some, you know, maybe a trend or, you know, something that you're seeing right now with people who purchased with private funds in the last 6 months. What are some of the things that you're hearing from those people now, and how are you helping them?
Yeah, so we're starting to see, I wouldn't call it that trend, but I've seen several deals of this nature over the past few weeks. And here's what we're seeing. Some clients who took private money in the past 6 months with the intention to renovate and flip or renovate and refinance, some of them are experiencing a challenge on exit. And what I mean by that is, again, values are softer than they had anticipated. In some cases, the renovations have taken longer, or they've even paid a little bit more than they wanted on renovations because of the supply chain issues. And we've seen a situation where some clients are short on exit when it comes to paying off the private money that they took. So on a refinance, they can't refinance at the new value and get out enough money to pay off all of the debt they took. Or on a sale, their property is sitting longer on the market, but also not getting the offers they were hoping to get. So it's not going to sell for the price they wanted, minus all expenses to cover the debt that they took on. So it's a very unique situation. I haven't seen it before. I'm starting to see it now, and we've gotten approached by several brokers and clients in the past 2 weeks, exactly with the same story.
Yep. Yep.
And again, what happened in the market, as we know, is it kind of turned very quickly. Like, honestly, no one saw this coming. Like, we know interest rates are going to rise eventually, but it just happened very quickly. So now some clients are in a situation where they have to revise their exit strategy and look at alternatives to exit the deal. And some also are experiencing expensive holding costs because, as we know, private money is a powerful tool, but it's also a little bit expensive, and you need to exit it sooner than later because the holding cost starts to add up. So some clients are in that situation as well.
Yeah, exactly. You said a lot of stuff there. And I'm just going to share my screen quickly if I can for 1 second. So one of the things that Dalia mentioned was that we're seeing downward pressure on values. And this is one market that I've been keeping an eye on, the Kitchener-Waterloo market in Ontario. And what this is the home price index. It's a lagging indicator. Without getting too far into it, it tracks percentage change over home prices in a specific area with, I believe it's 2005 as the base year of 100. So month over month, you're seeing percentage changes. So kind of at the top of the slide here is the analogy that I use. We're sitting at, call it 480, and right now we're at 374. So that's a significant decline. Dalia, just so our listeners understand, when you refinance a property, why is the value of a home important to refinancing a property, and what kind of limits are there?
So on a refinance, the lender will approve up to 80%. Traditional lenders will approve up to 80% of the appraised value, assuming that the client qualifies for such an amount. That's the primary driver of qualification. And if the value has softened, the loan amount will translate into less money at the end of the day. That's That's what it boils down to, right? On a purchase, Rob, it's the same idea. You're purchasing a property. The lender is going to lend on the lower of the purchase price and the value. So this is where value comes in. So if the value is below the purchase price, they're going to lend on that. If the price is below the value, they're going to lend on the lower of the two, because lenders are conservative. So value is key to either transaction.
Yeah, and that's a big thing. So in these markets where things are, you know, we're kind of on that slide, we're on the downward part of the slide, which is not fun. You're seeing a lot of people having difficulty being able to refinance. So if you're a borrower, so let's just kind of pretend that I'm a borrower and I'm a real estate investor and I've entered into a private mortgage at the top of the slide. I bought a house. The value is such where an 80% refinance does not pay out my existing private mortgage in full. What are some of the things that, what are some of the solutions, what are some of the tools that you're working on that potentially I could benefit from or that I could employ?
Yeah, so the first thing we would do is to look at your entire portfolio. Yes, you've got a property here that is experiencing some challenges when it comes to what we call debt to value. So where else in the portfolio can we look for money or extract money to offset any shortage that you're experiencing here? So you got a private mortgage. If we are to refinance and pay it off, we have a shortage. Can we cover this shortage from somewhere else in the portfolio? Is the first approach that we would take. And if the answer is no, we can't, then the second approach we would take is to say, okay, we've got a private lender on this property here. Let's work with some numbers. Let's say the property is worth $600,000, and let's say the private money owing is $700,000. So we're short $100,000 there, right? Now we actually, if we're going to refinance, we're going to be short a little bit more. If we're selling, we're going to be short $100,000. But let's assume we're going to refinance, because refinance is at 80%, right? It's not at 100%. Yep. So the second approach, so the first approach is to say, okay, can we refinance? And if you're experiencing challenges with refinancing, can someone else come on the deal with you to refinance, to help the numbers? Are there ways to restructure things in your portfolio to help you refinance? We're still dealing with a shortage here, so what do we do about it? The answer is, can we look here and cover it? That's number one. Number two, if we can't, what can we do? One of the things we've been able to do is to talk to the private lender who's holding the mortgage and say, hey, listen, guys, right now, the lien is above the value. If we pay you 80% by bringing institutional money in, or let's say another private lender in that is cheaper, and you have this much shortage, would you agree to get paid this much, which is the bulk of the money? And then we would move this shortage from this property, which is currently not secured, onto something else that you're comfortable with, where your money would be secured. And we start a new term there on a smaller amount. So this way, the client had exited, a more expensive mortgage. The lender got the bulk of their money. Yep. The client kept the property. The lender is still getting paid on something secure that they're comfortable with on a smaller amount until the time comes where we can actually pay that off, because the market will eventually correct. This is not, a slide down to the bottom of the pool here where we're all gonna sink or suffocate or die, right? It's just, it's a temporary thing that is happening. We just have to ride it, and then ideally hold on to the property and sell at a better time or refinance at a better time. So that's the idea.
Right.
The third option is, if we still have a shortage, there are lenders on the street that offer unsecured money. And they offer unsecured money, not in big amounts, but in small amounts, like $50,000, $70,000. And they're actually cheaper than some of the typical unsecured money out there. So maybe we can tap into those to offset some shortages in combination with the two first strategies I talked about.
Okay.
And then lastly, and that's the last resort, is if none of these things work, can you as an investor, bring a joint venture partner to the deal.
Right.
You got a renovated property, it's in a great location. You know you can rent it. The rental market is, you know, improving. There is higher demand for rents right now because affordability has gone down a little bit.
Yes.
Then you bring a joint venture partner to the deal. And that joint venture partner is essentially coming in, giving you a chunk of cash to buy into the property. So it's going to help clear some debt. They will help with restructuring the mortgage so we can bring the payments down significantly because maybe they qualify better than you. And we hold on to the property. So a combination of these tools is what we're using right now. Okay.
So to kind of recap, you said a lot of awesome stuff there. I want to unpack a little bit of it and just make sure that everybody's following along. So potentially I'm an investor, or we have an investor who is in a situation where they cannot refinance the exit of a full private mortgage. There's a bit of a shortfall.
Yes.
So your first solution is, one, to look at all of the other assets that this investor might own and see if there's an opportunity to leverage that asset to replace the one that's in a little bit of a precarious situation, if you will.
Yes, cover the shortage from one or more other assets.
To cover the shortfall. The second option was working with the lender to see if they would accept a partial discharge and take the balance of what couldn't be refinanced by the takeout lender on another asset.
Yes.
So that way the lender is still secure, the lender is still whole. They are taking a smaller portion of debt, taking back the vast majority of their mortgage, and applying that to another property. So the borrower is reducing their cost of capital, which that's the main benefit to them, and the lender's getting their money back.
Yes.
The third option that you discussed, well, I think it was kind of 3 and 4 were similar, but attracting a joint investor, or you talk about unsecured funds was a third option.
The unsecured loan, tap into unsecured loan options to cover any remaining shortages. And typically an unsecured loan is not going to cover the full shortage. It's just like a plug-in into a bigger strategy. It's just another small tool we can utilize. It's not a full solution.
Yeah, no, that it's a small piece. It's the cherry on the sundae, so to speak. You want to have the majority of the issue addressed. These unsecured funds are just a way to kind of get you across the finish line.
Exactly.
And then lastly, in the absence of those three things, talking about joint venture.
Yes.
So bringing on a partner. You mentioned a little bit about rents, the upward pressure on rents. We're seeing, people are buying less properties right now, but the rents are just shooting up right now.
Yes, exactly.
Which is actually an opportunity in itself in the multifamily space. We'll talk about that another time. But maybe for those who don't know a lot about how these joint venture agreements work and how they can go about understanding this, and then maybe even going to attract a JV, what would you say to those people? Your quick elevator education pitch, if you will, to a new investor. What would you tell them about joint venture and what it is and how they can start it?
Okay, so the quick summary on the quick crash course on joint ventures here is there are many people, maybe within your friends, within your family, within your network, who want to invest in real estate, but they don't have the time and skill. Where you as an investor have the time, have the skill, you've renovated the property, you know how to find tenants, that's your core competency. So by coming together, you would both benefit. They can put money into the deal to be part of, to co-own a piece of the property with you and a piece of the cash flow. And it would be, let's say, a 5 years arrangement. And there has to be an agreement called a joint venture agreement that your lawyer can draft. That would be binding. So they would come in with money. They would go on title, and you will do what you do best. You basically manage the property, deal with all of the headaches, and make sure that it's performing and they're getting a return and you're getting a return. That's essentially what a joint venture is. So there is an agreement that has to be put in place. It's legally binding. They go on title. And by bringing them into the picture, what another benefit is mortgage qualification, because they could qualify for a cheaper or a better loan than you going on your own on that loan right now. So that helps with the cost of money. It helps keep the property, and because they're bringing cash to the deal, that helps, you know, burn some of the shortages we're dealing with.
Yeah.
And it's not one, it's not either or of any of the strategies we discussed, Rob. It is a combination of how can we, yes, what can we do here, there too. Here's the shortage. There are two priorities, actually three priorities. How can I reduce the monthly holding cost for the investor? How can I reduce the burn rate?
Yeah.
How can I help the lender exit the deal, get most of their money out, reduce their losses?
Yep.
And three, the shortage. How are we going to deal with that? These are the three things we look at, and then we start to look at the best tools to bring together to come forward with a solution.
Yeah. Love that little wrap up there. I love how you broke down joint venture. Other people might hear this called co-ownership agreements, where depending on how much the new joint venture partner or business partner is bringing into the deal, you can actually divide up ownership on a title. So you can have fractional ownership. So say if somebody's holding 80% of the debt and you need that shortfall, somebody can register a 20% interest in title, and then they have an interest in title that's proportionate to their investment in the property. So there's a lot of creative ways that brokers and lawyers can advise you and structure these really unique solutions, because we're working with contracts and we're working with real property here. So you have an awesome team in Streetwise. There's lawyers who can come up with creative solutions. There are solutions out there is the main thing that I'm trying to say.
Absolutely.
So Dalia, this has been an awesome conversation. Is there anything else that you think a real estate investor on the topic of exiting private money that you'd want to bring to light?
No, we've covered pretty much everything, Rob. But one of the things that if someone is in the midst of a challenge right now, or someone is in the midst of a renovation and they know they're going to exit in a few months, I would suggest that they have a discussion right now, and if there is an opportunity to order appraisals on properties now,
yes,
versus wait, fast forward, it would be better to lock them in now, because appraisals are valid for 120 days, right?
Yep.
So this way, at least you've protected the value. I'm not saying that the values will continue to go down, but it's just a hedge if that happens. So that's the only thing that I would add.
Great piece of advice. And I just want to recap that again because it's so good. I'm talking with people and they're saying, hey, I'm just about done my renovations. I need to do one last bit. I think, great, order your appraisal yesterday. Don't wait 60 days because there's going to be more rate increases. We have an announcement on September 7th, I think it is.
Yes, it
Two
is.
more after that. We still got a little bit to go. Maybe it's that's not an uneducated assumption. And the sooner that you can get that appraisal done, and if the lender will accept it within 120 days or 90 days, depending on what their underwriting policy is, it's better to order it here than here, because then you have that extra value that you can potentially leverage in the market that you're in. So Dalia, this has been great. Always love taking the time to chat with you. If people want to reach out to the Streetwise Mortgage team, how can they get a hold of you?
Just simply email us at info@streetwisemortgages.com or go to our website, streetwisemortgages.com, and reach out to us through our contact form. And as I mentioned, we're helping clients. We're working with fellow brokers who want to, like, that second opinion to think together and get a deal done to service their client. And we're happy to be of service right now because there are challenges, and I don't want people to feel discouraged. Yes, it is a tougher environment. Yes, things are different, but the creative juices,
Yes.
you know, are working and we're finding solutions. They may not be the simplest, but there is always a way. And that's how we have to move forward versus throw the towel and go, oh my God, I didn't think of this. Oh my God, this is happening. I can't believe it's happening to me. No, let's talk. And there is always a way. And you may have not seen it, but once you talk to the advisor and, you know, you will be surprised sometimes of what's possible.
How can we versus why can't we?
Exactly.
That's the framework to take in this, and you
Love
got to
it.
have great people in your corner. So, Dalia, really appreciate the time, and
pleasure.
looking forward to our next chat.
Thank you, Rob. Have a great day.
Awesome.